Welcome back to Calm Investors. I am Ruth.
And I am Patrick and Ruth. I have noticed something about myself that I want to talk about.
Go ahead.
When the market is up, I feel like a genius I am making all the right decisions. I am a great investor. But when the market is down, I feel like I should never have invested at all. Like I made a terrible mistake. It is like my confidence is just tracking the stock market. Is that normal?
It is completely normal. And it is one of the most important things you have said all season. Because what you just described is not a personal quirk. It is a universal pattern. Every investor feels this, and every market cycle follows this exact emotional arc today. I want to give you a map of that arc, so that the next time your emotions are screaming at you to buy or sell, you can look at the map and know exactly where you are.
A map of emotions. Okay, I am listening.
So every market cycle, every single one in history, follows the same emotional sequence. It starts with optimism. Things are looking up. The economy is growing. Your portfolio is green. You feel good. Then optimism builds into excitement. You are making money. Your friends are making money. This investing thing is working.
That is where I am right now. Honestly, somewhere between optimism and excitement.
Good. Keep tracking yourself as I go through this. After excitement comes thrill. You are checking your portfolio every day. The gains feel amazing. You start thinking about what you will do with all this money. And then comes euphoria. This is the peak. At euphoria, you feel invincible. Everyone is making money. The market can only go up. People are quitting their jobs to day trade. New investors are pouring in because they do not want to miss out. The headlines are ecstatic.
That sounds like 2021.
It sounds like every peak in history. And here is the critical thing about euphoria. Euphoria is the point of maximum financial risk, not maximum safety. Maximum risk. Because at euphoria, prices are at their highest. Valuations are stretched. Everyone who is going to buy has already bought. There are no more buyers left to push prices higher, but it feels like the safest moment in the world, that is the trap.
The point of maximum risk is the point where it feels safest. That is terrifying.
It is. And then the cycle turns. After euphoria comes anxiety. The market dips. You tell yourself it is just a pullback. Then denial. The dip continues. You think? It will come back. It always comes back. Then fear. The drop is getting serious. Your portfolio is deep in the red. Then desperation. You start looking for someone to tell you it will be okay. Then panic. You cannot take it anymore. The pain is unbearable. You need to make it stop.
And that is where people sell.
That is where most people sell at panic or just after it. At capitulation, they give up. They sell everything. They move to cash. And then comes despondency, depression. They feel like investing was a mistake. They swear they will never invest again. And here is the cruel symmetry. Just as euphoria is the point of maximum risk, despondency and depression are the point of maximum financial opportunity when nobody wants to invest. When headlines are apocalyptic, when it feels like the world is ending, that is statistically the best time to buy.
So the time it felt safest was the most dangerous, and the time it felt most dangerous was the best opportunity.
Now you are thinking like an investor. Sir John Templeton said it best. Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. The cycle repeats, the emotions change, the pattern does not.
Born on pessimism, die on euphoria. That is powerful, but how do you actually know where you are on the cycle? Like, in real time?
Great question. And there is actually a surprisingly simple indicator. I call it the magazine cover indicator, and it has been remarkably accurate throughout history.
Magazine covers? Like actual magazines?
Actual magazines. And today, their equivalent, major news headlines, social media sentiment, the general mood of the public. Here is the principle. When investing makes the cover of mainstream magazines with euphoric headlines, be very cautious. And when the covers are apocalyptic, opportunity is near. Let me give you real examples.
Yes, give me the real covers.
In 2007, right before the financial crisis, major publications were running covers like The Bull Market, How High Can It Go? And Everyone is Getting Rich. The mood was euphoric. Investing felt like a sure thing. Within a year, the market had dropped over 50%.
And then in 2009?
In early 2009, after the crash, the covers were the end of prosperity. Is this the end of American capitalism? The death of the stock market. The mood was apocalyptic. Nobody wanted to invest. And March 2009 turned out to be the exact bottom. The market tripled over the next decade. The covers were perfect contrarian indicators. Euphoric covers marked the top. Apocalyptic covers marked the bottom.
That is incredible. So the mainstream media was basically telling you exactly what to do, just in reverse.
In reverse. Because mainstream media reflects the mood of the crowd, and at extremes, the crowd is wrong. We talked about this in our FOMO episode at the peak. The crowd is euphoric and buying at the bottom. The crowd is terrified and selling. The magazine covers capture that mood perfectly.
Okay. So I have the emotional cycle. I have the magazine cover indicator, but I want to be careful here. You are not saying I should try to time the market based on this, right?
That is a really important distinction, and I am glad you are making it. This is a map, not a crystal ball. You cannot predict when the cycle will turn. Nobody can. You cannot look at the emotional cycle and say, "We are at euphoria, therefore the crash will happen next Tuesday." That is not how it works. What you can do is identify where you are on the cycle right now, and that awareness changes your behavior.
How does it change your behavior?
If you can feel that you are near euphoria, everything feels amazing, everyone is making money, you want to go all in, the map tells you to be cautious, not to sell everything, but to be cautious, to rebalance, to stick to your plan. And if you can feel that you are near panic, everything feels terrible, you want to sell everything and hide, the map tells you this is where opportunities are born, not to bet the farm but to stay the course. Maybe even add to your positions if your plan allows it.
So the map does not tell you what will happen, it tells you how to respond to what you are feeling.
Exactly. Howard Marks, one of the greatest investors alive, wrote an entire book about this called Mastering the Market Cycle. And his core message is simple. You cannot predict the cycle, but you can position yourself appropriately, based on where you think you are, when the cycle is high. Be more defensive. When the cycle is low, be more aggressive, not because you know what will happen next, but because the odds have shifted.
The odds shift based on where you are on the cycle, even if you cannot predict the timing.
And Warren Buffett has been saying the same thing for decades in a simpler way. Be fearful when others are greedy. Be greedy when others are fearful. That is the emotional cycle in one sentence. When the crowd is euphoric, be cautious. When the crowd is terrified, look for value.
All right, so what is the practice for this week?
Here is what I want you to do. Search for the Wall Street emotional cycle chart. It is a well-known image that maps out every stage we just discussed. Save it, print it, put it somewhere visible, your desk, your phone wallpaper taped to your monitor, and the next time you feel strongly about buying or selling. Locate yourself on the cycle first. Ask yourself, am I near euphoria or near panic right now? Let the map override the emotion.
I love that, a physical reminder, because in the moment, you forget everything you have learned, but if the chart is right there in front of you, it forces you to pause.
That pause is everything. The difference between a good investor and a bad investor is often just a pause, a moment to check the map before acting on the emotion.
All right, let us lock in the key takeaways.
Number 1. Markets follow a predictable emotional cycle. Optimism, euphoria, panic, despair, and back again. The emotions change, the pattern does not. Number 2. Most investors buy near euphoria, which is the point of maximum risk, and sell near panic, which is the point of maximum opportunity. The emotional cycle explains why. Number 3. The moment investing feels safest and most exciting is statistically the most dangerous time to invest aggressively, and the moment it feels most terrifying is often the best opportunity. And number 4. You cannot predict when the cycle will turn, but you can identify where you are on it, and that awareness alone changes your decisions. A map, not a crystal ball.
And your homework. Find the emotional cycle chart, print it, put it somewhere. You will see it every day. Next time you feel strongly about a financial decision, locate yourself on the cycle first. Let the map override the emotion.
If this episode gave you a new way to understand your own investing emotions, follow Calm Investors wherever you are listening. Share this with someone who needs to hear it.
Thanks for listening, everyone.
Stay calm, build wealth,